Hi everyone, this is Mrs. V Chan. Welcome to my Form 5 Accounting lesson number 20. Today is 16th of May 2020. Okay, so today's topic, we have two topics here, limited company and correction of errors in this DSE question in 2016. Okay, yes, let's look at the question here and see what we need to do in this question. So first, we are given a statement of financial position at the year end. And also, we're given some points, additional information, and now we need to part A here to prepare necessary journal entries to correct the mistake. And also after that, we need to prepare a statement of financial position. Okay, so here we have the journal entry for the answer in part A, and don't forget to show this debit column, credit column, and dollar sign, otherwise marks will be deducted. And after that, we have the answer for statement of financial position of a limited company. Okay, and next we're going to look at the question step by step. Okay, so here, point number one. So point number one, we have this, a short-term loan. 456,000 was obtained to purchase a delivery van, costing the same amount on 1st December. Okay, so for this, whenever we have loan, so the best way is we analyze this step by step and then also we draw a timeline. All right, so here is the timeline for obtaining the short-term loan, and the date is on 1st of December, and then we credit short-term loan with this correct amount, which is 456,000, and the purpose for this loan is to get delivery van with the same amount. So this is the cost, 456,000 also for the delivery van. And the date is very important because we need to work out whenever we have loan, we need to pay interest for this month, which is 1 month of interest incurred. All right, okay, so if you go back to the question here, so for this loan we are not given any percentage to calculate interest. However, we have this, the loan and its interest totaling this 480,000 have to be repaid on 1st of May. So obviously this is less than 1 year, so that's why it is a kind of short-term loan. Okay, so even though we don't know the percentage for interest, we can still work out the difference between this. If you look at this, this is loan and interest total, 480,000. So therefore, the total amount repaid and the loan, the amount borrowed, is more than that. So therefore, we can analyze that in this way. So 480,000 being total loan and interests, right? And how much is the amount we borrowed for the loan, which is 456,000. So therefore, obviously, the difference will be total interests. So which is the difference? Okay, so I need my calculator. So 480,000 minus 456,000. So this is total interests. Okay, last two. The date is very important, so that will be according to the information, which is 1st of May 2016. Therefore, starting from this 1st of December up to 1st of May in 2016, so how many months altogether? So this is for total interests for 5 months. All right, so therefore at the end of financial year 31st December 2015, we need another double entry for interest incurred. So that will be debit interests on short-term loan, and this interest not yet paid, so we call that accrued interests, or it can be interest payable. Okay, so therefore the total interest is 24,000, and now for 5 months altogether and being incurred in for 1 month only. So this will be the calculation. So I would put this 24,000 total interest divided by 5. Okay, so I have this 4,800 and 4,800. Okay, next let's look at the wrong entry being done in the books. So that is that this total amount was mistakenly debited to the delivery van and then credit to the short-term loan. Therefore, here I have my analysis for the wrong entry being done. So debit delivery van, the total amount 480,000, and credit short-term loan 480,000. And actually you can see, you can prove and find evidence. If you go to look at the statement of financial position, you can check how much being delivery van for the cost, which is 480,000, right? And also short-term loan, we also have 480,000. And of course 480,000, this figure is wrong. Okay, because how much we need to debit delivery van, which should be 456. So you can see debit delivery van for 480 is too large. So how can we decrease delivery van? We credit delivery van with the difference. And also for short-term loan, 456 to be the correct amount, and now the wrong figure to 480 is too large. So to decrease that, we go to the debit side. So debit short-term loan also by this amount, by the difference. Okay, and then we need another double entry for interest incurred being omitted. So the adjustment will be this one plus another one. For that interest being omitted, I simply copy the double entry. So interest on short-term loan 4,800, and here, okay, accrued interests, which is 4,800. Okay, not only that, so since the costs for delivery van is wrong, therefore delivery van is too large, so what happened to depreciation? So depreciation also will be overstated. So if depreciation overstated, my double entry will be the opposite for depreciation. Therefore, I need to debit accumulated depreciation and credits depreciation with the overstated amounts, which is 24,000. Okay, and now I need to look at the method we use to calculate depreciation. So depreciate all non-current assets evenly over 4 years. Okay, so 4 years, so each year depreciated by 1/4. Again, this is very important, the timeline. So this happened on 1st of December, so only wrong for 1 month. Okay, so how much is that? So 24,000 divided by 4 and then divided by 12. So you can see the timeline is very, very important. Okay, next we need to look at the dates for retained profit. So since this is statement of financial position at the year end, this is also the retained profits at the year end. Therefore, all items wrong in the income statements should be adjusted in this retained profits account. All right, so therefore finally, here, before we show answer, we have to change this interest on short-term loan to retained profit, and also the depreciation changed to retained profit. So here is the answer after analysis, step by step. So here we have 3 double entries. The first one being short-term loan overstated and delivery van overstated, and here we have the loan interests being omitted and also depreciation being overstated. Okay, all right, so right after this double entry, go to adjustment in the statement of financial position. So here we have short-term loan being overstated, so minus 24,000, and accrued interest omitted. All right, and what else? And here for delivery van, the original amounts, we minus 24,000 for the delivery van, the cost being overstated, and then this is depreciation overstated. And finally, don't forget to show the adjustments for this. So we add depreciation overstated to retain the profits, and then we minus loan interests being omitted. Okay, next we have point number 2 here. It was discovered that some goods costing 32,250 have been damaged. So for all goods damaged to be treated as a kind of a normal loss, and then could be sold for 22,200 after having them repaired for 2,600. Now here we have the diagram to analyze inventory. We have this sentence to value inventory, saying that inventory should be valued at lower of costs or net realizable value based on prudence concept. We always choose a lower one. as not to overstates the value of assets. So here, this is the costs, 32,250,000. However, how much is net realizable value? This is the estimated selling price. The point is, if we don't spend money on repair, we cannot sell that at all. So this is the estimated costs for making this to complete the sales. Therefore, this is the value, 19,600 for net realizable value. According to process concept, we should always choose a lower one. So now we need to write down costs 32 to 19,600. So this is not a good thing. We suffer because we cannot sell this at a profit. So therefore, this is a bad thing. We debit profit and loss account. And then to reduce inventory, back down to net realizable value by the change, and the change is 32,250 minus 19,600, so that the change is this 12,650. Okay, and this double entry is related to inventory written down to net realizable value because of prudence concepts. And be careful when we show answer, this should be changed to retained profits. Okay, so here is my answer. In part A, we debit retained profits and decrease inventory by this amount. Okay, so you can see in the statement of financial position, so that's why we minus 12,650 from inventory. So this is just the answer for inventory. And don't forget debit retained profit, that means we have to minus this workings. All right, so the description is inventory written down to net realizable value. All right, so point number 3, a purchase order from customer for goods at an invoice price. Invoice price same as the selling price, and then with a markup of 25%. And here we have the formula to link costs with selling price, and that will be selling price is equal to costs times 1.25. Okay, was received on 30th December. The goods would be delivered to the customer on 15 January 2016. Okay, and then these goods were not included in the closing inventory. And now, here we have the analysis. So when we have purchase order received from customer, according to realization concepts, so the earning process is not completed yet. So therefore, we should not treat this as credit sales. And when should we treat that as credit sales according to realization concept? Which is when we have goods delivered to the customer, which is next year. So therefore, the double entry here is to reverse the credit sales. Therefore, we debit sales and credit trade receivable with the selling price. All right, since we do not have any sales this year, therefore, the closing inventory, we have to include this as part of the closing inventory. However, what's wrong? These goods were not included. Okay, so inventory should be included. So we can say that we have our inventory, which is understated. Here I have another double entry for inventory being understated because we have to include this instead of exclude us. So the double entry will be debit inventory and credits retain the profits. And don't forget, inventory should be always valued at cost. So here I need to change selling price into costs by dividing 1.25. Okay, so therefore the answer should be 15,000, which is the selling price. To convert that into costs, so divided by 1.25. So I have 12,000 and 12,000. Okay, and don't forget when we show, we have to change the sales to what? To retain the profits as well. Okay, so here is my answer to point number 3. Debit retain the profits, credit trade receivable for credit sales being overstated, and then debit inventory and credit retain the profits. because we have to include this as part of the closing inventory. This is the selling price, and this one should be at costs. All right, so after the double entry, so here we have adjustments affecting the statement of financial position. So you can see we need to add another 12,000 to inventory. So this would be the correct amount for inventory, and minus 15,000 from trade receivable. And also the effects on retained profits, we have inventory overstated, and also we have credit sales overstated. Okay, here we come to point number 4, which is the most difficult point in 2016. And if you look at the statement of financial position, you have this trade receivable 490,000, and here we have all the details about this 490,000. Okay, now we're going to analyze that step by step. So 490,000 for trade receivable, including this deposit received, and bracket here means deducted from trade receivable. And what should be the correct entry for deposit received? That means we have more money in the bank, we debit bank. And then we credit deposit from customer because we have no goods delivered to the customer yet. This should be treated as a kind of current liability. However, what's wrong in the books? We debit bank. And why being credit to trade receivable accounts? Because here, being 3,000 deducted from trade receivable, and this trade receivable is a debit item. Therefore, the firm, if you have a bracket here, that means the firm has credit trade receivable. All right, so once you have the correct entry and the wrong entry, and then you can get the answer by doing the adjustments. Okay, so you can see we don't have any mistake in the bank account. However, we need to cancel trade receivable and then treat this as a kind of current liability, so that my answer should be reverse this debit trade receivable by 3,000 and then treat this deposits as a kind of current liability. Okay, so this is the adjustment for deposit received. Okay, so after we have adjusted deposit received, now next we come to allowance for doubtful debts. So this is on the wrong figure for trade receivable. Therefore, how much should be the correct amount for trade receivable? So this is the wrong figure being overstated by 15,000. Therefore, to get the correct amounts for trade receivable, this should be the figure 488,000. All right. So 2% times 488,000 will be the correct amount for allowance for doubtful debts. So times 0.2. So the correct amount should be 760,000. But what about the wrong figure being included? So which is 10,000. So for this to change 10,000 to 9,760, therefore we need another double entry to decrease allowance for doubtful debts. Okay, so here is the answer to decrease allowance for doubtful debts. So we debit allowance for doubtful debts, and then we credit profit and loss for the change. So that would be 10,000 minus 9,760, so 240. So this is only the rough work and the analysis. So later on when we show in the answer book, we cannot use any abbreviation here, otherwise marks will be deducted. And also we have to change this profit and loss to retained profits. Okay, so therefore we have proper answer to point number 4, debits receivable and credit deposit from customer. And this is a new item here, should be treated as current liability. And also we have decrease in allowance for doubtful debts by the change. So after the analysis, okay, so for trade receivable, this is the adjustment. We minus 15,000 for sales overstated, and then plus this deposit should not be deducted from the trade receivable, and also this is decrease in allowance for doubtful debts. And the special thing in this question, so what is the treatment for deposit from customer? It should be a kind of current liabilities according to realization concept. And finally, here we have decrease in allowance for doubtful debts affecting the retained profits. Okay, so here we come to the final point, which is the bank reconciliation statement showing that there were 3 unpresented checks. But however, we have this one check issued. Look at the dates, which is 5th of May. So starting from 5th of May up to the end of December, actually this is unpresented check for being unpresented for more than 6 months. Therefore, it should be treated as a kind of stale check. So here is the diagram. At the end, we have cash book balance. All right, and I get this figure from here, 154,400. However, the balance in the bank statements being not the same, but we don't need to worry about that. Anyway, we have this unpresented check. There are 3, however, 1 being stale. So what does it mean stale check? Stale check means at the beginning, we pay check to supplier. So this is a double entry for pay check to supplier. So we debit trade payable and then credit bank. Is that right? So since this check being unpresented for more than 6 months, so it becomes stale. So the double entry to adjust that will be to write back the stale check by doing the opposite. So that will be debit cash at bank and credit trade payable. So this 11,800 should not be a kind of unpresented check. However, it should be right back and do that debit cash at bank and add this to reverse the check pay to the supplier. All right, so this is the answer to point number 5 for stale check written off in the cash book. So to debit cash at bank and credit trade payables, and right after this double entry, and here we have cash at bank, we need to add back the stale check, and then go to trade payable, we need to add 11,800 for stale check. All right. Okay, so since we have finished all the adjustments, so for the remaining answer, what we need to do is to copy, okay, the remaining items. We have no adjustments related to that. Okay, for example, we have no adjustment for office equipment, so therefore you just put this together to show the net book value here in the statement of financial position. And next, what's left? We have finished all the adjustments. And the ordinary share capital, I just simply copy that of ordinary share capital. Okay, and then here we also have a long-term bank loan. Long-term bank loan should be a kind of non-current liabilities. Okay, and finally, we need the workings about the adjusted retained profits. So if you use your calculator, all right, you will get this 235,290 as retained profit, adjusted retained profit. All right, so this is how we do correction of error, all right, combining with limited company. Okay, so that's all about the question in 2016. Thank you for watching my video. I'll see you next time. Bye-bye.